We're continuing with our Russell 2000 monthly income. Which ETF is best for you? We're going to compare all 5 of them on the screen and see which one fits the best investors across the board.
Hey guys, welcome back to the channel. I'm Doug, the Retirement Guy, with all your monthly ETFs. So here's the question that goes out there. Small cap stocks. They're known for volatility, but they're known for inconsistency of income. So how do you get income from one of these funds? Well, we're going to show that today. We're going to show how these monthly ETFs that work with the Russell 2000 generate income and how they actually generate income. We're going underneath the hood on this one. We're also going to find out what's the yield, what's the risk, and of course, what the total return is of each fund, and which one will fit best to our investors or you as an investor, which one will fit best for your portfolio. We're going to try to cover it all today. And before we do, I got to do a shout out to all of our Patreon and our YouTube members. You guys are phenomenal by help supporting the channel. Simple. If you're not part of the group, don't be afraid. Hit that subscribe button, hit that bell notification. And if you can, don't be afraid. Join the Patreon thing. It's not a cult. It's nothing. It's just basically you can sign up for free or you can help financial the channel. But all the information in there is available to most people across the board. Let's get into today's video about the Russell 2000 monthly payers.
So before we go any deeper into this, I gotta say this. This presentation is provided for educational purposes only and does not constitute financial advice. It's for educational purposes, no financial advice, distribution risk, and always contact a professional. I am not a professional. I'm a retail investor, very similar to you, except I've been doing this since I've been 27 years old. So why monthly income and the Russell 2000 is so different? Well, let's look at first. The Russell 2000 reality is it's made up mostly of small cap companies that reinvest their cash to grow their businesses rather than pay dividends. So realistically, they have low to really non-existent dividend yields compared to large cap stocks. And the higher volatility than large cap equities is really what you're really coming into play. Now, ETFs, the reality is ETFs must manufacture income through option overlays. Income sources include option premiums, capital gains, and sometimes even return of capital. Traditional dividend ETFs, the income comes from companies' dividends. So they'll put together, 3, 4, 10, 100 different companies that pay dividends and pull it all together to give you the dividends income. Now that's potential for long-term growth. The option-based ETFs income comes from option premiums. And that's going to cap your upside and limit that capture by the strategy that they use. So there is a difference between ETFs and regular ETFs and then ETFs and the Russell. So the source of income, options, and not dividends. All 5 of the ETFs today that we're going to show you generate income through option overlays rather than corporate dividends. So what we want to know then is how does the option premiums develop? How do they do it? The premium income source from, where's the premiums coming from? How are we getting, what kind of income are we getting? We want to sell the call options. The capital gains, we want to realize the gains from options and sales of the underlying securities, and of course return of capital, which we know is not earning returns, but it reduces the NAV and the cost basis for tax purposes down the road. Now the first one we're going to look at is RYLD, the Global X Russell 2000 Covered Call ETF. Now this one is established covered call strategy. And the overview of the strategy is it holds the Global X Russell 2000 ETF. So it's an RSSL is for that fund. And it uses it as its underlying exposure to the Russell 2000. It sells at the money covered call options on that Russell 2000 index. Now, the options guaranteed by the Option Clearing Corporation, OCC. Now, those are just the options. That doesn't mean any premiums. That does not guarantee anything. It just means that they have the options covered in their options that they sell. The key metrics, okay, I'm going to say right here, is the distribution rate. They're pretty much always giving you about 100% ROC classification of the distributions. So why is our RYLD's ROC so high? Well, they use a covered call strategy on a Russell 2000 index through their own ETF. So this is not traditional dividends for securities. This is all coming from option premiums. So for tax purposes, the IRS allows this to be classified as ROC rather than ordinary dividend income in many cases, especially when the fund distributes more than its taxable earnings in a given period. So they're really using this as a tax advantage and tax service for its shareholders. The distribution mechanism, it distributes half of the call premium generated. So you wonder, why do they do that? Because the remainder is reinvested to support the NAV growth. So when you take a look at the performance that we show here, a 4.88% since inception, 4.41% over 5 years, 7.62% over 1 year. So does this make any sense to anybody at this point in time? Well, if you're reinvesting for NAV growth, so they're trying to get growth out of it by taking and reinvesting, sounds like a drip, doesn't it? Sounds like they're dripping their premiums at 50% rate. So when we take a look at how is this done, how is it gone? Well, they have assets of $1.31 billion. They've paid out dividends of over $1.84, which is an 11.7% distribution yield. Now, unfortunately, because of April 2nd and how it's come out, it's taken longer time because of that capped upside to get itself out of the April 2nd issue. So this fund's still down 3.36% for a total return of 8.46 so far. Look at the distributions. The fund is technically generating about 30 cents per month. So it's putting 15 cents back in to help grow the fund and help and then pay out that distribution. So we can see as you align, and I know you're going to say, well, there's a lot of different spikes, but if you take a look from April 2nd all the way out here to 2026, you have an upward trending line. Okay, so this is what makes this fund actually have a underlying growth potential moving forward. Now, the second fund we're going to look at is ITWO. This is the ProShares Russell 2000 High Income. This one's going to give you more of a balanced approach. While the other fund trying to give you the growth through reinvestment, through dripping, these guys are using a daily covered call strategy on the Russell 2000 index. It's using swap agreements to sell call options without direct trading. It enables the daily rolling of positions versus monthly strategies. Now, when I look deeper into this one, this is what I pulled the information from, is what they're doing is they're doing a daily approach versus a monthly. Instead of sitting down and saying, we're going to set this price at a certain month and see if we can get it done, these guys are looking at daily. How is the market going? Up, down? Which way are we heading? So that they can go ahead and set their call options at where they need to be. More frequent premium capture, better aligning with the market, less frequent position rolling, and may miss the interim market movements. So those are the two. So in the daily approach, you're getting more frequent premium and better aligned with the markets versus a monthly that doesn't get as much frequent position rolling and may miss that interim market movements. So it's why this ProShares has a better upside than most. It still caps the upside potential by selling those call options, but then it fully exposed to the small cap drawdowns. Now, the performance so far, Russell 2000, the ProShares has been able to capture over 95% of the upside of the Russell 2000 because of their daily approach that they're doing. The performance you can see since inception, 17.37%, and 1 year at 19.76%, some very big numbers. But when option premiums are lower and the reinvestment is insignificant, the NAV may erode during prolonged bull markets. So when we pop the hood on this one, you'll see $112 million under assets, only a 0.55 expense ratio. They have over 2.65 million shares outstanding. It paid out $4.81 in dividends. The dividend yield is 11.52, very similar to what RYLD was, but look at the package so far. Even with the April 2nd drop-off, they've been able to climb, again, a straight record, very high angled growth side of it with a 4.45% growth for year to date. So they're already back. You would call this one recovered from the April 2nd drop-off, including the November market adjustment. So this one gets you into that 16.06% total return, paying a fairly consistent potential income of about 24 cents per share. So right now, the ITWO, in my own portfolios, I like this fund across the board because of its performance moving forward. Now we get into IWMI, the NEOS Russell 2000 High Income Tax Aware Distribution Design. Now we all out there, many people like the NEOS packages because they do things in a different way. The active option management, the dynamic tax-aware distribution management, the systematic option calling to generate that income, and optimizing after-tax returns. NEOS is known for this. They use 58.6% of ROC on their distributions. Now, the tax implications, return of capital, not tax at ordinary income, reduce the cost basis and defers your tax liability down the road. High ROC may signal significant concerns, but once you understand the market and what to look for, you can pretty much understand what the market's really doing. The performance, 16.69% since inception, 18.61 over 1 year. Now, what kind of investor is this suitable for? Well, I'm going to call it sophisticated investors, the ones who monitor their NAV. So this is not a program where I'm just going to say, set it, forget it, collect my money and be done. You want to pay attention to what's going on with the NAV. You want to pay attention to the assets under management. There's a lot of key factors you have to pay attention to when you invest in this type of fund. Do you get rewarded for that? Most definitely. It's not suited for the average investor, like I said, who's going to just set it, forget it, and be done with it, or those seeking simplicity. You need to understand and watch this on a fairly consistent basis. Popping the hood on this one. This is $481 million in assets. It's got $6.84 in dividends with a 13.56% dividend yield. So you're looking at about a 2% gain over the other funds that we've looked at so far. Now the fund came out in January of 2024, so we're definitely over a year into the fund. You can see it had its April drop off. You can see it's recovered again. This is the big thing with the Russells. Most of these have all seen that big, nice growth. And this one's totally recovered because it's back up over its previous point. And it gives you that 16.51% total return. Dividend wise, still 23, almost 24 cents per month. So very similar to what it was from the other funds. So this is again, and you're looking at this one with a tax advantage side of it. Now, when I say what are the things you now look at, when you come to something with an ROC, you want to be watching your assets. You want to see if the assets are going up or down. Okay. If they start using a lot of assets as return of capital to pay dividend, that's a negative thing, and that's when you know something's up. But overall, with NEOS, they have been a fairly steady company that has been very upfront and honest with most people in their funds. Our next fund, IWMY. This is going to be iShares Russell 2000 BuyWrite ETF. Now, this is a systematic buy-write model. We've talked about these before, and they're interesting strategies. The question is, does it really, really work? And I'm not going to say I'm a fan of it. I'm not going to say I'm against it. It's kind of like, it's a rule-based strategy. So let's get into this. It's a rule-based strategy and it's transparent approach. It sells call options continuously to generate that monthly income, but the income is tied to volatility levels. So they set the rules. This is kind of one of those things is they can almost, I'd say you put it with a computer. You set rules of what you're willing to do, how you're willing to do it, and where you're going to set your numbers at across the board. And if you get the the volatility, you're going to create the income that you're looking for. They own the index, and then they sell call options on those from that index to generate that monthly income. This one has more stability. It's predictable income stream, and it has a mechanical cap on the upside in bull markets. So there's no downside protection during drawdowns, but it does have a capped upside. So when we look at it, your inception is 9.06, 1 year 11.83. So again, at the bottom I put down here, you got the bull markets. You're going to have an upside capture. It's going to lag behind the index due to that option trading. Normal markets, moderate impact. Balanced performance with that systematic premium collection. That's the market you want, just plain old normal marketplace. And in bear markets, you have full exposure to the small cap downward. There's no protection at all in this. So you can see already it's red, and you can see that the market, the downward trend that we had in April 2nd, it has not recovered as well as the other funds have. And it hurt itself in the downward market. Now, the positive is it had a great yield. If you're yield chasing, you're at 20.44% yield. But once you take off the fund's growth of negative growth, you're down to 11.73. So it's not as strong as you once wanted to be. Now, we're going to talk a little bit about the assets. $39 million in assets. Expense ratio extremely low because 0.39, has 1 million shares outstanding. This one started March 14th of 2024. And again, you look at the chart, we just talked about that. You don't have the positive to grow the fund because of the downside protection. Now, I want to show one here. I know this is a little off kilter, but IWMY, which is the Defiance Russell 2000 Enhanced Option Income Fund. Now, this one used to be a monthly payer that they switched over to weekly. And it got some attention. And I wanted to explain this to you just to show the differences how weekly versus monthly play. They use a daily credit spread strategy on the Russell 2000 index. It targets a 30% annual distribution rate of the net asset value. Now remember, targeting is not guaranteed. Targeting means we're trying. Targeting means we're going to see. It uses synthetic exposure through swap agreements. So when you see synthetic, that normally means they're not owning the product. They're using other things to swap to get the exposure. So they may be swapping cash or treasury bonds, trying to get the Russell 2000 index. This is an enhanced income potential with higher distribution rates, but it's a very, very aggressive strategy. But we take a look at this, it's at 14.24%, 14.38% over 1 year. The biggest scare of this one is NAV volatility. Let's look at the fund under the hood. And this actually, I'm going to be honest with you, this is why I put this one in here, is because so many people ask me about this fund in about, can I get that 60% yield? Is that something worthwhile? Is Russell 2000 that strong? And that's when I started saying we need to add this to our, simplified investor program, is to say, hey, look, this is for the people who are chasing yields. This is where reality hits the road. The fund has $117 million in assets. It came out October 30th of 2023. Once they switched over to weeklies is what changed the game. Okay? And when I say changed the game, look at what happened on the chart. They were up to about a $30 price point. Now it dropped off. It was already dropping before April 2nd, so they already know that there's a major issue going on. That it dropped off April 2nd because of the tariff side of it, and it hasn't come up. It's gone down, down, down continuously. So this fund is down 31.20%. So that 59% yield you're looking at is actually a 28.76% total return. But your underlying, if you're taking all your distributions off the table, you're actually losing more money of your net value. And the distributions are talking about 11 cents per week. So times that by 4, about 44 cents per month. So it just shows you that a weekly, changing from monthly to weekly, it may boost your distribution, but again, if you don't have the proper underlying strategy, you're going to hurt yourself in NAV erosion. And that's what this one shows. Very, very heavy NAV erosion on the Defiance. So when we take a look at the ticker across the board, comparing all of these, so if you're looking at yield, of course, IWMY is going to be very popular, but IWMW is doing just as well, in my opinion. When you look at the growth, and if you're looking for stability, if you're looking for growth, ITWO is right there at 4.45% with a very nice 11.52% dividend yield. Now, NAV stability is very high in that fund. If this is an area that you're looking at, you want to maintain your cash in the bank and the money that you're investing, you're going to be looking at ITWO. RYLD, not bad, but there's better out there. And IWMI is that very low NAV stability. Okay, still has a positive growth, but a 16.51 total percent. So ideal investors, if you're an income focus like retirees, seeking consistent monthly cash flow or supplement to your retirement income is ideal. Technical income, people looking to boost their yield during specific market environments, and those sophisticated investors with high risk tolerance to that NAV monitoring, well, each fund has its own little piece to it. What these funds are not suitable for is buy and forgets, the capital appreciation seekers, and the panic-prone investor. And we see a lot of that. So our key takeaways from this: option-based income is income comes primarily from the option premiums, not dividends. That's the difference in a Russell versus the S&P 500 or the NASDAQ 100. The trade-offs: higher yields often means higher risk and potential NAV erosion. And that's why I left that one fund in there to show you NAV erosion is very clear and very understanding of it. The fund differences: each fund has a unique characteristic and a risk profile. So overall, which fund do you think is the best for you? Because every investor is different. I know where I sit, and I know what I feel comfortable with. Questions: where do you fit? Putting 5 funds up there, I'd love to hear what's your opinion on each fund or where you sit with it. Let me know if you like the series. Leave a comment down below, and we'll catch you at the next video.